It's a term born from a typo, a drunken forum post from 2013 that has since become a battle cry for millions of crypto investors. HODL, hold, on for dear life. The strategy is deceptively simple. Buy a cryptocurrency, like Bitcoin, and hold it. It's not for a day, not for a month, but for years, through dizzying highs and gut-wrenching lows, ignoring the noise of the market entirely. For some, this unwavering faith has paid off spectacularly, turning early believers into millionaires. But behind the celebrated success stories lies a crucial question that few dare to ask aloud. Is this cult-like devotion to holding a sound strategy for everyone? Or is it a dangerous path leading to financial ruin? The answer, as we'll discover, is a definitive and resounding no. To truly understand if HODL is the right path for you, we need to strip away the memes and the hype, conduct a detailed, unflinching analysis of its real-world advantages, and its often overlooked, devastating disadvantages. This isn't just about getting rich. It's about making informed decisions in one of the most volatile markets in modern history. Let's begin with the undeniable appeal of the HODL strategy, the reasons it has captured the hearts and minds of so many. Its greatest advantage is its sheer simplicity. In a world of complex charts, bewildering technical indicators, and endless market noise, HODL offers a path of zen-like calm. You don't need to become a day trading savant, glued to your screen, trying to predict the unpredictable. The strategy liberates you from the immense pressure of daily decision-making. You simply buy and you hold. This simplicity also brings a significant financial benefit, minimizing transaction costs. Every trade, every swap, every move you make in the crypto space incurs fees. There are exchange fees for the platform you use and network fees, or gas, to process the transaction on the blockchain. By drastically reducing the number of transactions, hodlers inherently keep more of their capital working for them, preventing it from being slowly eroded by 1,000 tiny cuts. Perhaps the most powerful advantage, however, is psychological. The HODL strategy is a formidable shield against the two most destructive emotions in investing: fear and greed. When the market is in a freefall and panic is rampant, the HODL's mandate is clear: do nothing. When prices are rocketing upwards and the fear of missing out FOMO is screaming in your ear, the rule remains the same: do nothing. This disciplined inaction prevents the classic investor mistakes of panic selling at the bottom and greed buying at the top. This emotional fortitude is directly linked to its potential for high long-term profits. History, particularly with an asset like Bitcoin, has shown that those who weathered the brutal bear markets and held on through multiple deep price corrections were rewarded with returns that dwarfed those of almost any other asset class. The core philosophy here is time in the market is more important than timing the market. It's a strategy tailor-made for those who aren't just speculating on price, but are investing in the long-term, paradigm-shifting potential of blockchain technology itself. However, for every advantage, there is a corresponding risk, and the disadvantages of a HODLing can be severe and financially catastrophic. The first and most demanding requirement is a level of patience that borders on superhuman. The crypto market doesn't move in gentle waves. It moves in violent, prolonged cycles. A brutal bear market can last not just for months, but for years. Imagine watching your investment plummet by 80% or more and then stagnate for 2, 3, or even 4 years. It requires an iron will and an unshakable conviction to stand firm and not capitulate when it feels like your investment is spiraling towards zero. This leads directly to the single greatest risk of the strategy: the risk of losing your entire investment if you choose the wrong asset. HODL is only effective if the asset you're holding eventually recovers and reaches new highs. If you decide to HODL a coin that is based on hype, has weak fundamentals, or is ultimately a failed project, you're not an investor. You're just a passenger on a sinking ship. Your unwavering loyalty will lead you to a 100% loss. Furthermore, by committing to a long-term hold, you inherently miss out on short-term opportunities. Active traders who can skillfully navigate volatility can generate significant profits by buying dips and selling rallies, compounding their gains while the HODL simply waits. Another critical risk is security. If you leave your precious crypto on an exchange, you are not in control. You are entrusting your assets to a third party, exposing yourself to the ever-present risks of sophisticated hacks, or, as we've seen time and again, the exchange itself going bankrupt. Storing it in a personal, non-custodial wallet is the answer, but this brings its own immense responsibility. If you lose your private key or your recovery phrase, your assets are gone forever, irretrievably locked away in the digital ether. There is no customer service to call, no password to reset. You are your own bank, with all the freedom and all the terrifying responsibility that entails. The HODL strategy is also fundamentally unsuitable for anyone with short-term financial goals. If you need that capital for a down payment, an emergency, or any other life event, locking it away in a volatile asset is a reckless gamble. The market doesn't care about your timeline. Finally, you are betting against the relentless pace of change. A project that seems revolutionary today could be rendered obsolete by a new technology or crippled by a sudden shift in government regulations tomorrow. So, who is the HODL strategy actually suitable for? It is for a very specific type of individual. It is for the true long-term investor, the person whose investment horizon is measured not in months, but in years, or even decades. This is someone who genuinely believes in the transformative power of the underlying technology and sees the current price as mere noise on a much longer journey. They must be a higher-risk investor. Someone who is not only willing, but also financially and emotionally prepared to accept massive price swings in exchange for the potential of outsized returns. They are often busy investors, professionals who don't have the time or desire to actively manage a portfolio and prefer a simple, set-and-forget approach. Critically, they must be psychologically stable, capable of remaining calm and disciplined when the market descends into chaos. Most importantly, they are people who invest in projects with proven, solid foundations, vacations of success like Bitcoin or Ethereum, which have weathered multiple market cycles, boast massive networks, and are supported by a global community of developers. Conversely, it's equally important to identify who should absolutely avoid this strategy. The HODL approach is completely wrong for short-term investors or traders who aim to profit from market volatility. It's a disastrous choice for low-risk investors, those who cannot stomach the idea of their principal investment being cut in half overnight. It's unsuitable for anyone who needs high liquidity and might have to access their funds on short notice. It is a recipe for failure for the impatient, the individuals who get easily discouraged or panicked by market downturns. And most dangerously, it is not for the uneducated investor, the person who buys a coin based on a friend's tip, a celebrity endorsement, or trending status, without doing a single moment of deep fundamental research into the project's technology team and tokenomics. For this person, HODling is not a strategy. It's a blind gamble. In summary, the HODL strategy can be an incredibly powerful component of a diversified cryptocurrency portfolio, especially when applied to blue-chip assets with a clear long-term vision. However, it is far from a one-size-fits-all solution, and treating it as such is a perilous mistake. To apply HODL effectively and responsibly, you must follow a strict set of rules. First, only HODL assets that you have thoroughly researched and in which you have developed a deep, fundamental conviction. Don't just believe in the price, believe in the project. Second, clearly define your personal investment goals and your intended holding period before you invest a single dollar. Third, consider using a dollar-cost averaging DCA strategy, investing a fixed amount of money at regular intervals. This minimizes the risk of investing your entire capital at a market peak. Fourth, and this cannot be overstated, prioritize the safe storage of your assets. Learn how to use a cold wallet, protect your private keys and recovery phrase as if your life depends on it, and never share them with anyone. Finally, you must always be mentally and financially prepared for extreme volatility. Understand that deep, prolonged corrections are not a bug, but a feature of this market. For the investor who values simplicity, seeks to minimize emotional decision-making, and holds a genuine long-term belief in the future of cryptocurrency, HODL remains a worthy and potentially life-changing strategy. But never forget the fundamental truth. The crypto market is an arena of high risk, and no strategy, no matter how popular or time-tested, can ever guarantee a profit. Invest wisely, invest with knowledge, and hold on not just for dear life, but for the right reasons.